Good morning. Um, Welcome to Accounting and Financial Management. We've already introduced each other. We know a little bit about each other. And this is the first lecture material, including course material for the course. Um, and this is drawn from, but not directly drawn from, but parallels chapter 1 in your textbook. Just a few housekeeping details. The way I run this course, if you haven't had a course with me before, it's similar to how I run other courses online, is I will lecture in 20 to 30-minute segments, followed by a couple of follow-up questions. These follow-up questions do not directly affect your grade. They're not graded questions. However, I use them to determine whether you've absorbed what I've talked about in the lecture. And if I see significant numbers of you who haven't, then I may revisit a topic later on. So it's sort of like asking questions in class, though we're doing this on a virtual method. You are required to do them, and you can't go on to the next lecture until you've answered the questions. So they're sequenced. So you do need to answer the questions. I do read them. I will comment on your answers individually, and I may change the lesson plan a little bit if I see some holes, things that people are missing. I think it's a good exercise for you as well, because I think it sort of cements the important points of a particular segment of a lecture. So for each chapter, there may be 2 or 3 lectures. So let's say they're 25 minutes apiece, so there may be 50 or 75 minutes of lectures related to each chapter. And obviously, these are segmented out by weeks. So this is week 2, and this is the beginning of the lectures for this course. And we'll start with chapter 1. You know that chapter 2 is a self-study, and it's there for your use if you are somewhat weak in Excel or need some refreshers in Excel. In addition, the school subscribes to something called VTC, which is a learning tool for all sorts of software. So it's free to you. And you sign in with your school first class name. So for me, it would be mark.shaughnessy and then my password. And there's tutorials out there for Excel, there's tutorials for Word, there's tutorials for a lot of other non-Microsoft programs as well. PowerPoint is another Microsoft one that's in there that I use. So I actually use this. I use Excel a lot, but I jump in there every once in a while when I can't remember how to do something, or I know Excel should be able to do it, but I don't know how to do it. And you can just search for the topic you're interested in, and you'll get a 3 to 5 minute tutorial on how to do it. So very, very useful. Take advantage of that while you're here at MMA. It's free to you as students. It's not, it's, I think, relatively not terribly expensive, but $150 a year for you to get if it's not provided. So useful. So what is financial management? Well, we're going to talk about that. It's basically composed of 2 different or 2 component pieces. It's composed of the accounting piece and the finance piece. And in this course, we're going to cover both the accounting and finance. So we're going to cover financial accounting, we're going to cover managerial accounting, which are 2 very different fields, and we're going to cover finance as well. So 3 different areas, all of which are on the dollars or numbers side of the business model, but all of which do different things. And we're, we're going to look at all of those pieces during this course. So a lot of material to cover in some graduate courses. Let's say you're getting an MBA with 60 credits instead of an MS with 36 credits. So a general MBA, you would probably take 3 courses. You'd take a financial accounting course, a managerial accounting course, and a finance course, even if you weren't concentrating in those areas. So we're gonna compress some stuff. What I'm really interested in doing is making you financially literate. So we're going to try to do that in this course. Um, so accounting information is to provide um, the base information for financial and managerial accounting. So what we do in accounting is we track transactions. So you've got a small case study that you got to do this week, um, set in the Middle Ages. So it's an old case study, I guess. Um, and uh, what I'm asking you to do is see if you can track the transactions, and in tracking the transactions, be able to answer the question that the Baron Castine has. Um, so transactions, uh, selling something, buying something, paying an employee. There's lots of different kinds of transactions, investing, receiving investment, investing in other things, borrowing money. All of those things are transactions, and they all get tracked by the accounting system. And then financial accounting and managerial accounting use those transactions to do what they do. And then finance is really where the money comes from. How do we get the money to do things? Everything we do, whether we're a for-profit or not for-profit, requires resources. We can't run a nonprofit school like MMA without resources. We have to have a learning management system. So we have to have something so that you guys can learn online. Without the learning management system, this would be a very difficult, if not impossible, course to teach. We have to have computers. We have to have an office for the teaching faculty. We have to pay them. We have to hire and pay the teaching faculty. That's really important in my mind. We have to have a finance office. We have to have a student affairs office. We have to have IT people. We have to have all sorts of things. We have to have resources. And those resources are not free. So we have to have the resources available to acquire the resources that we need. Usually that's money. In the US, that's dollars. You'll see in the case that you're dealing with, you're not going to deal with a monetary unit. You're going to deal with a barter unit, but you're still going to come up with a unit of measure. So finance is out there finding and acquiring the resources that the firm needs, and or disposing of the resources that the firm no longer needs. So financial accounting, it's formalized. It's a set of rules, and it records a firm's financial history. So what does the firm do? What has the firm done? It's history, remember. So what have we done in the past quarter, in the past 6 months, in the past year, or in prior years? How have we performed? So it's statistics. It's like sports statistics. How many yards did a running back gain? How many points did a point guard score? How many goals did a soccer player score? We're compiling statistics and then publishing those statistics. And we're doing it with a set of rules so that we can compare apples and oranges. So we can compare Microsoft and IBM. They follow the same rules so that we can compare their financial statements and their financial performance. Once again, the case you're doing, you're trying to compare the performance of two peasants. How did they do? Did they do the same kind of a job? Did one do better than the other? What was their performance? So that's what financial accounting does. So financial accountants report out to stakeholders, so stockholders and other stakeholders, and they do it with something called financial statements. And financial statements are highly regulated. Everything that's in them follows a set of rules, which we'll learn a little bit about, not a lot, but a little bit about. Those are called, in the United States, generally accepted accounting principles. Internationally, there's a different set of rules, which are called International Financial Reporting Standards. They're similar. They come from the same root of trying to achieve certain things, like comparability of different companies and consistency and so forth, reliability. But they've branched off, and so the rules are somewhat different. So if you have a company that operates internationally and in the US, they probably have to prepare two sets of financial statements, and those two statements will actually show different answers. So the US statement may show higher or lower income and a different balance sheet, different set of assets and liabilities than the international statement, because the rules are different. So think about that in sports terms. International hockey plays on a different size rink than National Hockey League hockey, and some of the rules are different. So we can't really compare performance of a particular team between international and NHL standards because they're running on a different set of rules. So that's kind of the simple explanation of the different standards. Managerial accounting is different. Managerial accounting uses the same set of data, all the transaction data, but it tries to look forward. It looks and acquires information and uses that information to help make good decisions. Financial accounting is a historical recording of what's happened in the past. Managerial accounting looks forward. Managerial accounting really doesn't have rules. You can do whatever you want in managerial accounting. There are best practices. We're going to learn those best practices, but there's no overriding body that says you have to look at a particular decision, financial or accounting decision, in a certain way. You can do it any way you want. Using that same sports metaphor we used before, it's sort of like a coach. A coach can look at all the statistics for his upcoming opponent. He can watch film. He can see exactly what happened. He can read the statistics that says that this running back runs between the tackles and gets this many yards per carry, and this is his characteristics, and this quarterback can pass, 70% of the time he completes his passes and all that. What the coach does with that information, how he analyzes it, and how he prepares for his next opponent is totally up to the coach. There's no rules that tell him you've got to look at this statistic or you've got to look at that, or if you see this, you have to do that. Once again, there may be best practices for coaches in certain situations, but coaches have the ability to use the information any way they want. In addition, managerial accounting information is not shared. As the coach wouldn't share his game plan for his upcoming opponent, managerial accountants use their information internally, and they don't share it with their competitors. So they don't say, well, we're going to invest in a new very large ore carrier because we think that our analysis is this is going to be a profitable investment. We don't share that with our shipping competitors, not at all. Or we're going to put in a new gantry lift in our port because we see these kinds of efficiencies and this kind of return on investment. We don't necessarily share that with our competitor port or competitor terminal across the bay. So those are the kinds of things that managerial accounting is used for. Structure in most companies for financial management, you have the accounting structure and you have the finance structure, and they're somewhat separate. Under accounting comes financial accounting and managerial accounting. Financial management, you might have the CFO up there in that dark green space, the controller in the accounting space, and then in finance, the CFO may also handle finance directly, or there may be a finance director under the chief financial officer. So every company is a little different, but that's the basic org chart for most at least reasonably sized companies. Finance really is there to improve decisions that affect the wealth of the firm's owners. So wealth, what's wealth? Well, income. So we want to improve the income of the firm's owners. Is that the only thing that wealth measures? So what's the measure of wealth for Maine Maritime Accounting? Well, we have financial statements. We have an income statement that shows us how much income we made. We have a balance sheet that shows us our net assets. So we have assets and we have liabilities. The difference between assets and liabilities is our net worth or our net assets. That's wealth. Okay, we've got X million dollars in assets and we've got Y million dollars in liabilities, and the difference between the X and X minus Y equals Z, and Z is my wealth. Well, is it? That's a financial number. What's the real number? What is wealth? Does Maine Maritime have the wealth of its alumni, the wealth of the knowledge with the people that teach, the wealth of its good professors, hopefully? What other things does Maine Maritime possess that don't show up in financial numbers? So there are other numbers for wealth than just financial numbers. As an example, Coca-Cola has a very powerful brand name, I think we'd all agree. It also has a secret formula for its prime product, Coca-Cola, the actual drink Coca-Cola. And that's a secret formula, supposedly in a safe somewhere in Atlanta, Georgia, to either the value of the brand name or the value of the secret formula show up on Coke's balance sheet. Is that an asset that shows up on the balance sheet? It isn't. Neither of those things are on the balance sheet. They were developed internally. Somebody invented the formula. I don't know his name, but I'm sure I could find out if I looked. And they have worked for the last 100+ years developing and expanding on the power of the brand name Coca-Cola. So those two things are assets or wealth, but they don't show up in the balance sheet of Coca-Cola. You won't find them there. So therefore, finance is about increasing wealth, which isn't necessarily increasing tangible or intangible assets that show up in financial records anyway. Now, Coke's wealth is recognized by the stock market because the stock market pays, people will pay more for the stock than the net worth of the company. So the net worth of the company is one thing, but people will pay more for that because it has more earning power than that. So another way to measure wealth is earning power. So the main goal for financial management is to maximize firms' profits. Now, there are other things that companies need to do, but financial management primarily looks at maximization of profits. And if we're talking about nonprofits, it's maximization of the benefits to the charitable purpose. So if we're running a school, it's the maximization of the benefits to the students, both past, present, and future. For Red Cross, it would be the maximization of the services that they provide. For a church, it would be the maximization of the spiritual benefit to their members. So ways that you can achieve profit maximization: you can maximize sales. That's one way. So grow the top line, if you will. You can maximize market share. So rather than trying to grow sales, I'm trying to get the biggest share of the market that I can. Can maximize growth. Another thing I could look at, let's grow fast. We're not looking at the maximum number of sales. We want to grow fast. We want to minimize expenses. You guys are mostly logistics students. You're mostly on the operational side. The operational side is all about reducing costs or minimizing expenses. We can optimize the use of assets. That may be our goal. To achieve profit maximization, we want to optimize asset utilization. We want our ships on the water working more often or as often as possible. We don't want lots of downtime in ports. We want them out on the water moving stuff, moving stuff. Or we can reduce our capital expenditures, minimize our capital expenditures. Any one of those things has the potential for maximizing profit. If I maximize profit, and I'm publicly traded, my stock price will go up, and I have more resources available for either distributing to owners or reinvesting in the organization, improving my charitable purpose of a nonprofit. So those are our goals. I'm going to stop there for this first lecture. There are a couple of questions following this, follow-up questions I call them, and then you can continue with the lecture after you've done the follow-up questions. Thanks much for listening, and answer the questions, and I'll see you later. Bye.